Introduction: the lie you've been told about wealth. If you think the key to getting rich is just working hard and saving money, I have bad news for you. That's not how the wealthy do it. They don't just work hard. They don't just save. They play by a completely different set of rules they don't want you to know. Here's the cold truth. The rich don't build wealth the way they teach you in school. And if you follow traditional advice, like keeping your money in a savings account, avoiding debt at all costs, or blindly investing in whatever's trending, you're already at a disadvantage. In this video, I'm exposing 3 secret truths about investing that the rich don't talk about. These are the strategies that separate millionaires from paycheck to paycheck living. But here's the best part: once you learn them, you can start applying them immediately, no matter where you are financially. And to prove it's not just theory, I'll share real-life case studies of how these strategies have been used to create massive wealth, even by people who started with almost nothing. Let's get started. Secret number 1. The rich don't chase high returns, they manage risk. Most people believe that the key to getting rich through investing is chasing high returns. They look for the next big thing, whether it's the latest stock, cryptocurrency, or startup that promises massive gains. But here's what the wealthy understand that most people don't. Investing isn't about how much money you can make, it's about how much money you can afford to lose. This is why the rich don't focus on maximizing returns. They focus on managing risk. Take Warren Buffett, for example. While millions of investors were jumping into high-risk tech stocks during the dot-com boom of the early 2000s, Buffett largely stayed away. He didn't care about short-term hype, he cared about long-term risk management. When the dot-com bubble burst, many people lost their life savings, but Buffett's portfolio remained stable. Why? Because he invests in a way that limits downside risk while still allowing for strong returns over time. The rich use asymmetric risk investing, which means they look for opportunities where the potential downside is small but the upside is significant. Instead of betting everything on a single stock or investment, they diversify across multiple assets, stocks, bonds, real estate, and even private businesses. This way, if one investment fails, the losses are limited, but the gains from successful investments continue to compound over time. Another key strategy the rich use is hedging against market downturns. While most investors panic when markets crash, the wealthy are prepared. They often keep a portion of their money in defensive assets like gold, bonds, or recession-resistant stocks, ensuring that they don't suffer catastrophic losses when the market takes a hit. Some even use options trading strategies to protect their investments from significant drops. But risk management isn't just about where you put your money, it's also about how you think. The average investor asks, "How much can I make?" while the wealthy ask, "What's the worst that could happen, and can I survive it?" This mindset shift is crucial because it prevents them from making emotional decisions that could destroy their wealth. So, how can you apply this in your own investing strategy? First, stop chasing hype. If an investment looks too good to be true, it probably is. Second, diversify your portfolio. Don't put all your money into a single stock or industry. Third, invest in assets that generate consistent cash flow, like dividend stocks, rental properties, or businesses. This way, even during a market downturn, you'll still have money coming in. The bottom line? The rich don't get rich by taking reckless risks. They get rich by protecting their money first and letting wealth build over time. If you start managing risk like the wealthy do, you'll be on the right path to financial success without falling into the traps that wipe out most investors. Secret number 2. The rich use other people's money. OPM. Most people believe that the only way to invest is by using their own money. They spend years saving up, hoping to one day have enough to buy a house, start a business, or invest in stocks. But the wealthy don't think like that. Instead of relying solely on their own capital, they use other people's money, OPM, whether it's from banks, investors, or strategic partnerships, to grow their wealth at a much faster rate. Take Elon Musk, for example. When he started Tesla, he didn't fund it entirely with his own money. He raised billions from investors, secured government grants, and used loans to scale the business. Even today, Tesla continuously raises capital from investors to fund its growth instead of just relying on profits. Jeff Bezos did the same with Amazon. Rather than waiting years to save enough to expand, he reinvested every dollar Amazon made and took loans to grow the company faster. This is how the richest people in the world scale their wealth, by leveraging capital that isn't entirely theirs. Real estate is another classic example of how the rich use OPM to their advantage. Most real estate investors don't pay cash for properties. Instead, they take out mortgages, allowing them to control valuable assets while putting down only a fraction of the total cost. Imagine you have $100,000. You could buy one property in cash or use that money as a 20% down payment on 5 properties worth $500,000 in total. Not only does this allow you to own more real estate, but your tenants are also paying off your loans while your properties appreciate in value. This strategy, known as leverage, is how real estate investors build massive portfolios with minimal upfront investment. But leveraging OPM isn't just for the ultra-wealthy. Ordinary people can apply this principle, too. Many successful small business owners start with loans instead of waiting years to save up. Entrepreneurs secure angel investors to fund their startups while still retaining ownership of their companies. Even in the stock market, some investors use margin accounts, which allow them to borrow money from their broker to amplify their gains. However, not all debt is good debt. The rich understand the difference between productive debt and destructive debt. Bad debt, like credit card loans or car payments, drains your wealth because it doesn't generate income. Good debt, on the other hand, is money borrowed to acquire assets that appreciate in value or generate cash flow, such as real estate or a business. So, how can you apply this strategy to grow your wealth? First, stop thinking of debt as an enemy. Instead, think of it as a tool that, when used wisely, can help you build wealth faster. Second, look for strategic ways to leverage other people's money, whether it's through real estate financing, business loans, or investment partnerships. Third, always make sure that borrowed money is used to buy income-generating assets, never borrow just to fund a lifestyle. The bottom line? The rich don't wait to have enough money to invest, they find ways to use OPM to start building wealth immediately. If you start applying this mindset shift today, you'll open the door to opportunities that most people never even consider. Secret number 3, the rich buy time, not just assets. One of the biggest differences between the rich and everyone else isn't just the amount of money they have, it's how they use their time. Most people spend their entire lives trading time for money, working 40+ hours a week and hoping to retire someday. The wealthy, on the other hand, don't just invest in assets like stocks and real estate. They invest in buying back their time so they can focus on activities that generate even more wealth. Think about it, if two people each earn $100,000 a year, but one of them works 80 hours a week while the other works just 10 hours, who is truly wealthier? The person who has time freedom. The rich understand that time is the most valuable asset of all because once it's gone, you can never get it back. That's why they prioritize investments and systems that allow them to make money without having to constantly work for it. Take Tim Ferriss, author of The 4-Hour Workweek. He built multiple businesses that run almost entirely on automation. He set up systems that allow him to generate income without being involved in daily operations. Instead of managing every small detail himself, he outsources tasks, hires virtual assistants, and automates his income streams. This gives him time to travel, learn, and explore new business opportunities while his investments and businesses continue to make money for him. The same strategy applies to investing. Most people think that making money in the stock market requires constant buying and selling, analyzing charts, and staying glued to financial news. But the wealthy don't waste time trying to beat the market every day. Instead, they invest in passive income-generating assets like dividend stocks, index funds, and real estate. These types of investments provide consistent cash flow without requiring daily effort. Another way the rich buy time is by outsourcing work and building scalable businesses. Instead of running every part of their business alone, they hire teams, delegate responsibilities, and create systems that function without them. Take Elon Musk, for example. He doesn't personally build Tesla cars or SpaceX rockets. He hires the best engineers and leaders to run the companies while he focuses on strategy and innovation. So how can you apply this principle? First, stop thinking only about earning more money. Start thinking about how to make money without trading your time. Look for ways to automate income, whether it's through investments, online businesses, or rental properties. Second, outsource low-value tasks. Instead of spending hours doing administrative work, use virtual assistants or automation tools. Third, create scalable income streams, whether it's an online course, a YouTube channel, or a business that runs without constant management. The bottom line? The rich don't just work hard, they work smart. They focus on building income streams that free up their time, allowing them to pursue bigger opportunities and live life on their terms. If you start thinking like them, you won't just be investing for wealth, you'll be investing for freedom. Conclusion: the 3 secrets that will change your financial future. Now that you know the 3 secret truths about investing that the rich won't tell you, you have a choice to make. You can keep following the traditional path, working hard, saving a little, and hoping that someday you'll have enough money to retire. Or, you can start thinking and investing the way the wealthy do, focusing on risk management, leveraging other people's money, and buying back your time so you can create real financial freedom. Remember, the rich don't chase high returns. They focus on protecting their wealth first, ensuring they never lose everything in a bad investment. They don't rely solely on their own money to invest, they use leverage and other people's capital to scale faster. And most importantly, they don't just collect assets, they invest in buying their time back. setting up systems that generate income without requiring them to work constantly. Now, it's your turn to take action. Start by shifting your mindset. Stop thinking like an employee or a saver and start thinking like an investor. Identify ways to diversify your investments, use strategic leverage, and build passive income streams that don't depend on your time. The sooner you apply these principles, the faster you'll start seeing real financial results. So, which of these secrets surprised you the most? Let me know in the comments. And if you're serious about learning more wealth building strategies, hit that subscribe button so you don't miss out on future videos. Your journey to financial freedom starts today, so take action and start investing like the wealthy do.